Hi, I'm Patrick Reid from the Adamus Principle. I've joined with BluFX and we are doing a trading on how to trade wonky markets. I say wonky, I mean abnormal, irrational, whatever you want to call it, but there are some golden rules, golden takeouts. So if you want to know more about mentorship, hook me up, connect me on LinkedIn. But you know, the reason I'm with BluFX is they are the best start for any trader. They help you with their forum and they support you at all levels. So without further ado, I just want to talk about now, you can see my charts, but I just want to also talk about where we're at, why it's important to learn how to trade wonky markets. And wonky markets to me means that price action that isn't really doing what it's supposed to do. It's not respecting levels. When we get good data, it does the opposite. Moves come out of nowhere, right? This is to me a wonky market, and I just want to kind of very briefly explain why we're here. It's an apt week because we've got non-farm on Friday. 4 weeks ago, we had a firm headline. However, it was all about wages. Higher wages was the big focus, and that basically caused the correction, in my view. Quite a few other participants would agree. The events that happened, in my view, and many people's views in the market, and I talk to a lot of institutionals each day, is this. Higher wages basically meant more money in people's pockets. More money in people's pockets means they're going to spend more. If they spend more, things get more pricey. That means CPI goes up. Inflation, if you will. When CPI goes up, there can be inflation fears. So yields spiked. Because with inflation fears, you're going to have to raise interest rates to cap it, right? This took the equities really badly. So what happened? We had a bit of an equity sell-off as a result. Not quite the 10% correction at the time, but what that did is it caused the VIX spike, and it was a short vol squeeze basically that caused the proper correction because there was mechanical selling via VAR models, via various risk models, and here we are. There was a lot of option hedge funds that got turned over basically, and a lot of rebalancing of books, a lot of this, a lot of that. But at the end of the day, we're now in a new norm. You can't unring the vol bell, and I've been blogging about that on LinkedIn quite a lot. So it's quite apt that we've got a non-farm payroll week, and it's quite apt that you understand that this is all normal. Abnormal is normal, and the key rules that stood the test of time for myself and you know my mentors who've taught me are the following. Rule number 1, okay, trade the wide and pick your spots. What does that mean? Okay, I want you to imagine you're in a bar and everyone's drunk and there's a fight that breaks out. Okay, there's a barroom brawl, right? Do you go in the middle of the bar and there's punches flying everywhere? You're probably going to get knocked out. It doesn't matter how tough you are, how big a trader you are, you will get knocked out. Or do you sit on the side on a bar stool and wait and pick your fight, pick your spot? This is a kind of analogy I just try and get through to you, okay? Now, we've been like that. We've had this for 33 weeks. Last week it calmed down a bit, but we're still getting 3 words: cross asset volatility. So we're getting flows from aftershocks or tailwinds from that correction on the equities, and also bonds came off as well, so be careful. We're still getting that. prices are price action is starting to respect levels and moving averages. You can see on my euro dollar chart here, and I'll go through that a bit more later in the webinar. But rule number one, as I said, pick your why. So right, last night, okay, so it's now the 5th of March. I had some trades got filled last night. If you look here, when I say trade the whys, I mean you don't really want to be trading in the middle of any kind of range, right? Let me just open this up. Okay, so here, right? You know, I'm just going to get my pen out and I'll show you. You know that here, here, and here, all tops, okay? So here it's probably going to top, yeah? That's what I did. And guess what? It topped. You don't really want to be trading here or here, all right? So just trade the whys and just go at the very top. And, you know, you might get lucky. You might not. You know, maybe do some buying down here. Don't do some buying here, possibly. That's the idea. I mean, there's no finite rule on trading the tops, but look at the average true range. This is what I normally do. In euro dollar, it's around 90 ticks. If we've moved, you know, 30 ticks, then I wouldn't be trading that because you've got a lot of room to roam. If the highs and lows are around 70, 80 ticks, maybe you could trade the ranges there. Yeah, that's the idea. So rule number one, trade the wide and pick your spots. Pick them wisely. Rule number two, when something doesn't do what it's supposed to do, get out, right? Now, it sounds pretty straightforward, but I'll give you an example. Okay, the US CPI, I want to show you something. You see this here, right? This was the US CPI. It was Wednesday. It was the 14th of April. Sorry, 14th of February. It was firm. It was really good. So the dollar started to sell, i.e., sorry, the dollar started to go up. It got lifted, i.e., euro dollar started to sell. Came down, came down. This is on the hourly. Came down, came down. Great. It probably retraced a bit here. So what should have happened? It should have stayed at the lows, potentially made new lows and closed at the lows, because I think that it was 0.3 higher. Massive for CPI. It didn't do that. Okay, so this is what I do when a big bit of data comes out. I put the fib on, and I've put a fib from here, just pre-data, down to the bottom, and then that should have stayed below 38%. Okay, so around, let me have a look. That should have stayed below there. 123.18. It didn't. And if it doesn't, get out. Yeah? Then you had a massive short squeeze. Not only did it go past entry, it rallied. No one knows why. Okay? If you see that happening, get out. Close your computer. Stop trading. It's not doing what it's supposed to do. Okay? That is wonky. It's a wonky market. It happens. Right? Rule number 3. I'm going to touch a little bit on yield curves. Some of you may know how to trade this, some of you may not, but basically yield is the opposite of the price of bonds, in particular US yields. It's a massive narrative for me. I've been blogging since last year. There's a divergence with 10-year yields and spot. Fixed income or yield traders and certainly spot traders who are differential traders will look at yields and go, spot will always follow yield, and that has certainly happened and certainly normally does happen. It's not happening. Wonky, right? It's not good. So that's another reason why you should really watch it. This is the chart I'm going to just put up in a second. Will show you the divergence between the US dollar and the dollar index. Okay, so many people who are differential traders will say, okay, well, it'll be only a matter of time before spot catches up with yield. Yeah, that's right. Sometimes it will take 3 years. If you look around 2006 to 2008, there was a huge divergence, huge. And then obviously around 2012, they kind of married again. And what the point I'm trying to make is we've been diverging for about a year and some change. This could go on for another year, maybe 2 years. And you know, how deep are your pockets, right? I mean, many of you are retail. I know some big guys who have very deep pockets. They're not going to hang around. They're going to go wait. Okay, that's just another sign of a wonky market. Okay. Rule number 4: how to trade a wonky market. If something can't go up on good news, it's going to go down twice as bad on bad news. Yeah. Look at dollar yen on Thursday last week. ISM was good. It was like 60. Expectation was 58. I'm going to show you on my chart. Let's have a look here. Okay, so around here was when ISM came out. It didn't really, I mean, obviously we had Powell and the testimony, the part 2, which kind of was a slight disappointment. Part 1, Powell played good cop, part 2 he played bad cop, but the fact is ISM's a big figure. You know, it's the Institute figure, and it's very good. The dollar should have been lifted and it didn't. So there's another thing, just be wary. Okay, the rule number 4 is quite important, because you know, if you get really good data and the dollar can't go up on good data in the US, what do you think it's going to do on bad data? In particular to that is dollar yen. It's just been going south. I mean, it's a slight bit of an uptick, but we're still consolidating at the lows. Okay. There's another reason for this. We get Japanese yen buying for repatriation for Q1. It always happens every year, but I'll cover a bit more on that later. So those are the 4 key rules you need to know on how to trade a wonky market. I just want to take some time out to remind you what I said in the intro on how we are at this wonky, abnormal, irrational place in markets. It's important for you to understand why we're here, not to dwell on it, but just important to kind of understand the mechanics of it. So like I said before, 4 weeks ago we had higher wages. It led to inflation fears. We had a 10% correction on equities. Bonds came off as well, which is unusual. Risk parity models got hammered. This is all due to a short vol squeeze on the VIX. Basically, this has created the market trying to find a new norm. Hasn't quite found it yet, but it's starting to look like it's finding it. And the key thing that I look for as a trader is to say, is it respecting levels? Is it respecting the moving averages? Is it respecting swing highs or swing lows? Is it respecting fibs, trend channels? Is it respecting, trend lines? Yes and no. It's a lot better. So what I want to do now is just take you through G5, and you can sort of, along with me, decide whether it is or not. And, you know, tell me I'm wrong. But right now, let me have a look. If I said to you, is this respecting? Well, yeah, kind of. It went through the 200 hour, but respected the 100. That's a good sign. It failed to go past the 200 and bounced up. not quite made up here, which is a swing high. Remember, all of these swing highs, yeah? So it kind of is on euro dollar. Just going to rub those out. Let's look at cable. Cable's got its own problems, so be careful of that. As you can see round here, it's hugging a couple of little levels there. It's hugging the 100-hour. That's 138.37. That's a tiny level up there. It kind of respected that. So the early signs are good, but we're not out the woods yet. But these are little things I respect. I would say on cable, if it comes up to the 200-hour and respects it, that's a good sign. Yeah. So you can kind of feel that the market's finding its footing. This is on the daily. I'll just stick to the hourly now. Euro sterling's not a good example at the moment. Dollar yen, we're still at languishing the lows with slight uptick. I would look for these levels up here: 105.90, 106, 106.10, 106.35 area is not a bad level because you've got 100-hour creeping lower. If it goes up to there and respects it, good sign. Bear in mind, dollar yen is a risk on, risk off pair. So when there's a risk off, levels don't get respected at all. So that's another thing. And then obviously Kiwi. Yeah, if you look at here, it broke through, bit of a bounce on the 100, bit of a bounce. It's kind of respecting it, good sign. If it comes up to here and respects it, 72.70, good. That means you can kind of define your risk, set your levels, set your stop, and you can kind of start to trade a bit more size. So the conclusion of that, not quite out the woods yet, but we're getting there. Keep looking at the markets and look for clues. Always look for clues. So there you have it. It's understand the abnormal is normal. We are changing. It won't last forever. Stay happy trading and stay safe. So moving on, I just want to talk a little bit about the macro fundamental side, which is always good to know, especially when you're trading the wonky markets. Let's get that off. Just to give you a little update, go back to basics. What is the dollar doing in broad terms? Is it going up? Is it going down? Is it going up and down, i.e. mixed? At the moment, certainly last week, it was mixed. So let's just look at the US data. CPI is firm, jobs okay, GDP mixed, QT increasing, that's quantitative tightening, opposite of QE. For those who didn't know, equities have bounced from the 10% correction off their highs, nowhere near their highs. So the rate hikes, three base scenario, base case, 4 possibly. On the risk side, high yield credit spreads are still low. CDS is a slight uptick, nothing major. So all kind of good, and I always go through all of those every so often just to try and sort of sense check the macro side. The key thing here is if you don't understand something, don't trade it. I don't understand everything all the time, and if I'm not sure about something, I just won't trade it. You've got that option. That's why trading's good. You can set your clip size. You can decide not to trade. If you feel uncomfortable about it, close your laptop, close your computer, play some golf, do whatever. So I just want to sort of talk about, before we wrap, I want to talk about flows, repatriation, and a bit more about volatility. These are some considerations I want you to bear in mind when you are trading this time, which is, we're at the tail end of this wonky market, this new norm. We're at the end of a business cycle. This is normal, as in abnormal. We've got Q1 Japanese yen buying for repatriation, which is weighing heavily on dollar yen. That most of the heavy lifting has been done. It's a lot of it's been done in February. It could end at the end of this week. No one really knows. When it does end, you might get a lift on dollar yen. As I said before, you cannot unring the vol bell, so volatility is going to be here. Maybe not as much as 3 weeks ago, but it will still be here. I talk a little bit about carry. Carry trades, I don't know if you know, but basically you sell a low yielding currency for a higher yielding one. If that gets unwound, especially like in Eurodollar on the 2016 China credit crisis, Eurodollar was rallying hard up. It was rallying, and I was selling into that, and I got hurt. So just be careful. That could happen. Unwinding of hedges, backup of interest rates causing a yield spike. Before issuance, that's another consideration. A pre-melt up before shakedown of weak longs. That's another thing that could have happened. It could have been my great aunt in Geneva short covering 4 yards of cash in spot. That's a joke, obviously. The point is, no one knows. Yeah, you can analysts out there, traders out there will try and find a reason for everything. Sometimes no one knows, and sometimes it's best not to know. The fact is, if you don't know and you're not feeling comfortable, as I said before, don't trade. Couple of finally and finalies, cut your size, reduce your trading, relax, because things never last, which means we're in an abnormal market. It's not going to last. We are going to get normal eventually. I hope that's helpful. I hope stick by the rules, and good luck with your trading. You can also go and play some golf. Thank you very much. Thank you for joining me on this wonky adventure. If you want to know more, look me up on LinkedIn, hit me up, or go to bluefx.co.uk.